Hey, Jeremy Finger, certified financial planner and investment management analyst over here at Riverbend Wealth Management. Here to answer the question, how does daily market fluctuations affect how we invest money? A lot of times I hear people say, oh, the market went up. That's a good thing. Or the market went down. That's a bad thing. Well, maybe. We all know that if we eat right today, that doesn't necessarily mean we're going to lose 10 pounds tomorrow, right? The same goes with investing. It's like if you do the right thing today, it doesn't necessarily mean that your investments are going to do well tomorrow. But if we do the things right on a daily basis, it does increase the chances of us getting better results in the future. Does that make sense? Yeah. So if you take a look at the chart here, you can see if you make some daily habits today, good habits, that over the course of 2, 3, 4, 5, and 10-year period, you can generally get some better results. James Clear talks about that in detail in his book, Atomic Habits. If you improve by 1% per day, you achieve a 37 times return over the course of a year. Okay, and that's what that looks like. And so what very successful people do is they focus on their habits, whether it be eating, exercise, investing, and that they know that one donut won't kill them, but a daily habit of a donut may, right? Or investing wise, hey, if I invest today, it doesn't mean I'm going to get a good result tomorrow, but if we do it consistently over time, generally it's going to work out. And so in the second chart, you can see the variance between, historically speaking, of what a 1-year return is. If you put your money in the market today, you can see there's a wide variance of what it would look like over a year, over 5 years, 10 years, 20 years. All right. So wouldn't we have all wished we invested more money 20 years ago? The same goes. You might be saying the same thing 20 years from now, and that is today. Another question that I also get is like, what about market at all-time highs? How does that affect us? Well, if you take a look at this chart here, is that from January 1st, 1988, if you invested on any day, just some random day, in 3 months, you typically would have gotten a 2.9% return on your money. If you invested in all-time highs, only invested at all-time highs, your average return for 3 months would be 2.5%. For 6 months, on a random day, it'd be 5.8%. And then a 6-month period on an all-time high would be 6.2%. Actually, a little bit more if you invested in all-time highs. A 1-year average return, random, 11.9%, and 13.7% if you invested at all-time highs. Now, again, this is the S&P 500 from January 1, 1988. All right? And you can see what your returns would have been in 2 years and 3 years. So this is a lot like the apple a day keeps the doctor away. A good habit right now is not going to guarantee anything, and it's not going to make a drastic difference in the next day. But when you combine these different small habits, over time, it increases your chances of success in the future. All right. So don't be too fearful about markets being at all-time highs. Don't be too fearful that one donut's going to kill you. But if you do good habits over time, generally your results are going to be pretty good. And if you have bad habits over the time, your results are going to generally be pretty bad. All right. Make sense? If you have any questions, comments, certainly feel free to reach out to us at Riverbend Wealth Management, 843-970-1049. And email is jeremy@riverbendwm.com. Thank you. And disclosures for all the attorneys out there. If you get any questions about anything, certainly feel free to give us a call at 843-970-1049. and or send me an email at jeremy@riverbendwm.com. Hope all's well with you and your family, and you have a great week. And let us know if you have any questions. Bye-bye.